Ever wondered how to start investing your money wisely? Well, it's time to unravel the mystery. Today we'll delve into the world of investment strategies, designed specifically for beginners. Investing, at its core, means committing money or capital to an endeavor with the hope of generating a profitable return. This could be anything from stocks and bonds to real estate and commodities. Knowing your risk tolerance is a critical first step. This term speaks to your capacity and readiness to endure changes in your investment's value. Factors such as age, financial goals, investment timeline, and your comfort level with market volatility all play a role in determining your risk tolerance. Next, we have a word that you'll hear a lot in investing circles: diversification. This strategy involves spreading your investments across different asset classes to minimize risk. Think of it as not putting all your eggs in one basket. Diversification can help protect your portfolio against significant losses. When planning your investment strategy, consider your time horizon. This is the length of time you intend to hold on to an investment before you'll need access to your funds. A longer time horizon often allows for more aggressive investment strategies, as you have more time to recover from any potential losses. First, we have the buy and hold strategy. This strategy involves buying securities, such as stocks or bonds, and holding on to them for a long period. This approach relies on the belief that the overall market tends to rise over time, despite short-term fluctuations. Second, there's dollar cost averaging. With this strategy, you regularly contribute a fixed amount of money into an investment, regardless of market conditions. Over time, this can help average out the purchase price, reducing the impact of market volatility. Then, there's index fund and ETF investing. This strategy involves investing in funds that track a specific market index, like the S&P 500. It offers diversification and typically lower fees compared to actively managed funds. Value investing is another strategy to consider. This approach focuses on finding undervalued stocks that are trading for less than their intrinsic value. It requires thorough research and analysis of individual companies. Dividend investing, on the other hand, focuses on investing in stocks that pay regular dividends to shareholders. This strategy can provide a regular source of income, especially for income-oriented investors. Real estate investing involves purchasing and managing physical properties for rental income or capital appreciation. This strategy requires a solid understanding of real estate markets and property management. After making your investments, it's important to monitor and adjust your portfolio. Regularly review your investments to ensure they align with your goals and risk tolerance, and adjust as needed based on changes in your financial situation or market conditions. Finally, remember the importance of risk management and diversification. Avoid putting all your money into a single investment or asset class. Instead, consider having a mix of different types of investments to balance potential returns with potential risks. In conclusion, investing is a journey, and like any journey, it requires planning, understanding, and a little bit of courage. But with these strategies in your toolkit, you're well on your way to building a solid financial future. Remember, the best time to start investing was yesterday. The second best time